Hey guys, it's Aman
and Christina
from Our Rich Journey. On today's video, we are talking about 8 investment mistakes that you can avoid when investing in the stock market.
Now, after 20 years of investing in the stock market, these are some of the 8 common mistakes that Aman and I have observed. So if you're new to the stock market or if you're a seasoned investor, these are still things that you should look at so that you avoid these mistakes when investing in the stock market.
So our number one mistake is only investing in companies that you know.
Now, we need to caveat this because our investment experience is that you should be investing in stocks that you know, but you shouldn't have a superficial level of knowledge in those stocks. If you know specific stocks, you do the research to determine whether or not they're good investments.
So when Christina says superficial knowledge, what she's talking about are people that invest in companies that they generally have knowledge about, like Apple, Tesla, Nike. These are all companies that most young investors are very familiar with, and they just buy the company because it has name brand recognition, and they're not doing the research.
So a study showed that the top stocks owned by millennials are Apple, Amazon, Facebook, Tesla, and Netflix.
And why is this the case? Because those are the most recognizable stocks by millennials. They have an iPhone, they watch Netflix, they buy things off of Amazon. We all do those things. But those things are the mantra. They know these stocks by their names. So the mistake that people make by only investing in these companies that they recognize by name is that they're not doing their due diligence. They're not listening in on their quarterly calls. They're not looking at their annual income statements. They are not doing the research that you do when you invest in individual stocks. Also, you may be missing out on a whole swath of stocks because you're just focused on these name brand stocks. There are thousands and thousands of companies out there, and you may be missing opportunities to invest your money somewhere else.
And the second mistake is that people trade too often. Now, studies show that the longer you hold, the more successful that you'll be. When you trade more often, you're subject to more fees, higher taxes. There's just more costs associated with trading so frequently.
And you are also more susceptible to emotional trades. You see something in the news or someone tells you something and you just automatically trade the stock. People that do this often don't realize all the benefits with holding a stock for years and years. I mean, you look at a company like Coca-Cola. If you hold that company for decades and decades, the return on that is amazing. But if you're jumping in and out of Coca-Cola, you're not going to realize all the benefit in holding a company like that for the long term. And number 3 is getting caught up in the stock market frenzy and not realizing that a drop in the market is a good thing.
So a drop in the stock market is actually great for investors who understand that investments are long-term. When there's a huge drop in the stock market, you actually get to invest in stocks at a discount.
So rather than selling at this time, this is actually a great opportunity to buy. You see, people get caught up in the stock market frenzy and hear things like, the stock market is crashing, it's done, let's sell everything. And the reality is, that doesn't make any sense at all. Because every time someone has said that, the stock market has come back even more. We always say that the stock market always goes up, and that has been true. History has shown us that. But what is even more true is that there will be more highs. So whenever there is a low, there is always going to be another high. So don't get caught up in the stock market frenzy. And the fourth mistake is not having a diverse portfolio. A lot of people will get started in investing because they love one particular company, and they'll pour a lot of money into that company. And whatever the whims of that company, so goes your investment.
Now, I want to be clear, we are not saying don't invest in individual stocks because we have individual stocks that we invest in, but it makes up a very tiny portion of our total investment portfolio. Really, we are focused on ETFs and index funds to get the diversification of our portfolio because that's where we're going to be the most successful.
So if you do feel the urge to buy individual stocks, don't just invest in 1 or 2 stocks. You should be building a portfolio that is made up of at least 10 stocks. Like our Robinhood portfolio, for example. We have 10 stocks in that portfolio because the diversification allows us to rebalance between the different stocks. It also tracks different companies. And so by having those different companies, when one company is doing bad, another company may be doing well. But it is that diversification that we are allowed to achieve with that portfolio.
And number 5 is investing without a plan. When you don't have a plan for your investments, you don't know how long you should be holding them, when you should be rebalancing them, how you should be allocating your portfolio. All of these things are necessary in order to build a successful portfolio.
And this point about a plan is very, very important because we often get this question from people, should I invest in this particular stock or this particular ETF? And we always have to tell people we don't know your plan, so we can't make that recommendation. Because your investment plan is more than just one portfolio. It also has to deal with your lifestyle. When do you want to retire? Do you have access to other accounts that you need to be investing in? Do you have debt? There are a number of things that go into these plans. Now, these plans don't have to be very complex. Our plan fits on one sheet of paper. It is very simple, but everyone should have a plan in place before they start investing.
And number 6 is relying too heavily on the experts. Now, if you rely on experts or professionals, sometimes their goals do not align with your goals. Their goals can be focused on bonuses, commissions, trading fees. They might not have your best interests in mind.
See, when you rely too much on experts, you can get burnt. This is your money, people. You should determine how your money is allocated. So we believe strongly in financial literacy. And by gaining that financial literacy, you can invest in confidence. And number 7, and this one is a huge mistake, but people grapple with this all the time. And it's refusing to invest because they think the market is too high or the market is falling too low. It's called market timing. And no one can really time the market. And when we first started our Robinhood portfolio, one of the things that we got beat up in the comments for starting to invest in December when the market was dropping. But can I ask you, when should you start investing? Should you keep your money on the sidelines and wait? You can't time it. What you have to do is just consistently invest. And if you're investing over the long term, regardless of what the market is doing, you will make money. Now, there is this amazing saying that really I hope sinks into a lot of people's psyche when they think about investing. And it goes, it is not about timing the market, it is time in the market. That couldn't be more true because the longer you're invested, the more successful you will be. And the final mistake that we've seen is that people are paying high fees. Now, fees are something that come along with investing, but you can seriously avoid the high fees by keeping your investment portfolio very simple. Low-cost index funds or investing with an app like Robinhood where there are no commissions for trading. But still, to this day, people are paying 1 or 2 or even 5% to advisors to manage their money. And those advisors are doing what you can do yourself. They are investing your money in ETFs or index funds. And that's really all you need to do in order to achieve financial independence and be a successful investor.
So these are the 8 common mistakes that we see people making when they're investing in the stock market. Now, one of the great things about these 8 mistakes are that they are completely avoidable. So keep these things in mind when you're investing in the stock market. And if you like this video, make sure you give us a thumbs up, subscribe to our channel, and join the journey.